Are you working with a budget of $450 plus and want to know which of the regional areas of Victoria is potentially the best to invest in?
We're expecting a strong growth year again for 2025, potentially even 2026 as well.
Arjun Paliwal, property investor, founder of InvestorKit, and research analyst, unpacks the top Victorian towns to invest in when working with a budget of $450 plus.
We can see some strong population growth rates, not just in the recent times, but it's been booming since about 2015. People might be surprised going, hey, can I get in the fours? And short answer is yes, you can.
But not only unpacking a list, but actually ranking it as well, giving you a better understanding of which could potentially be the better place. But not everywhere is set for growth right now.
It's actually gone from 13 days on market to 56, so it's more than double.
That's way more than double. That's huge.
These aren't long-term fundamental weaknesses. They could clear up over the years ahead. It's just that myth buster there for many people where they think that, a long-term market, it's not going to be great because it's a regional town. Well, guess what?
So if you're working with a budget of $450,000 plus in 2025 and want to understand more about the regional areas in Victoria, you're going to enjoy this episode. My name's Todd Sloan. This is the Pizza and Property Podcast, and this episode is powered by Full Circle Finance, InvestorKit, Future Proof Property Advisory, and Property Strats. More about our amazing show sponsors in the show notes below. But right now, let's get into this list with Arjun Paliwal.
Arjun Paliwal. How you going, man?
I'm good, mate. How are you?
Mate, very good. I'm not used to seeing you like this. It's like you fell in a bucket of razor blades. You're looking sharp, mate.
Oh, mate, it's a work in progress. I've been shedding some pounds, feeling good, feeling better, and going along this path.
Well, it's showing, man. But today we're going to be talking about I want to say some areas. Everyone's talking about Melbourne at the moment, and there's a bit more talk now about regional Victoria. And I know there's a lot of value to be had out there, but not all Victorian towns are really created equal. Hence, one of the reasons of going through this list with you, but not only going through it, actually having it ranked from yourself and the whole data team at InvestorKit. But I wanted to ask you though, before we start, is there anything you wanted to set the stage with this one before we start unpacking the list, man?
Yeah, absolutely. So I think right now, when the whole talk of Victoria has been centered around Melbourne, many people are missing out opportunities across different parts of Victoria and perhaps not having them front of mind. So this is going to be a great episode to dive into that today. But the other thing as well is that people forget that Melbourne isn't cheap, although it may be valuable because of how the price performance hasn't been there for some time, how people look at it from that city in comparison to other cities. Sure, valuable might be different, but it's not cheap. And so I think the key thing to remember is that because it's not cheap and the cash flow isn't all there, whilst yes, some families and some households can handle it, not everyone can. And so if you're ignoring other parts of Victoria and you're maybe changing your tune from a Melbourne house to a Melbourne unit, the biggest mistakes we see people make, you would rather avoid that and tune into the end of this show, because when you do, you're going to learn about all the different towns in Victoria and what they offer.
Well, it's something that I thought was really important with this, because right now, a lot of the sentiment is like, my household doesn't bring in $200,000, $300,000, $400,000 a year. So with this, I mean, obviously, depending on your circumstances, everyone's personal financial situation is different. But if we're looking around the 450 mark, sometimes that can be secured on as low as like 70 grand, depending on your deposit. So this is like opening up the doors for a lot more people to potentially get into the market.
Absolutely. So whilst, yes, it's not easy to buy in these markets with 450K, it is most definitely possible. It takes the right time, the right diligence, but obviously with the right market selection and expanding your horizon to more parts of Victoria, you're going to be able to make it happen.
Awesome. All right, man. Well, why don't we jump straight in then? Let's not keep anyone in suspense for any longer. Now, we're not going to go in the order of like best to worst, last. However, let's just start going through it. Which is the first one actually on your list?
Yeah, absolutely. So we've got Albury-Wodonga first in front of me. Now, Albury is an interesting one. It falls in New South Wales and Wodonga fits on Victoria.
I was going to say, you kind of counting them both together, or how would
counting them both together as one. I think from a population size as well, it's also good to look at them from one. And that's showing some interesting signs. So I'd love to go into that.
All right, let's talk a few stats.
Okay, cool. So I think the Albury-Wodonga market, what surprises many people is that it's a very consistent performer. And over the last sort of 10 and 20 years, when you look at market averages, this is where things get interesting. Over the last 15 years, Albury-Wodonga has a long-term growth average of just under 6%. And over the last 20 years, the long-term average is about 5.75. So 15 and 20, it's kept up with major markets. But what surprises many people is that they think that because the city's so affordably priced and it offers many affordable options, surely it must not be a performer because it hasn't grown. But it just started off a really, really low base. And so that's something to point out.
So that consistency you're talking about, like what was that again? 5.4% or 5?
Yeah, so it's in that mid fives to about just under 6% per annum.
Can you
from
just give
the
it
last 15 to 20 years?
Sorry to interrupt you there, but can you just give us like a capital city comparison to that, sort of to put that in perspective for anyone that's a little bit more newer at property investing?
That'd be very similar to most of the majors, whether it's Brisbane, Adelaide, Sydney or Melbourne. They've all kind of hovered around that mark as well over 20 years. So it's just that myth buster there for many people where they think that a long-term market, it's not going to be great because it's a regional town. Well, guess what? Albury-Wodonga's done just as well as all our major capital cities. All it did is had a lower starting base back then and a more affordable price today. And so as a result, people discount that thinking it hasn't grown. But if you've got a different starting point, you're now offering opportunities to those who may not have the income to buy something in Melbourne or Sydney, or may not have the deposit to buy, but still generate well-placed long-term returns. And that's the thing, that leveraged growth of an affordable asset, even call it 450 or 500K, is still growth on an asset that's far bigger than what you can save each year, right?
Yeah.
And so as a result, you don't want to sit on the sidelines waiting until you have $1 million budget. That would be silly because that market, if it's growing at just under 6% over a 15-year average, it's outpacing you far more than what you can save. And when that's that last ring of affordability you want to be in or you can be in, don't delay that. Like be in that market and grow with it, especially if its rankings and performance are just like the cities that you're aspirationally trying to get into.
All right, and what about yield? Because that's one of the good things about going a little bit more regionally Victoria is because like Metro Melbourne is not known for having strong yields. What's Albury-Wodonga sitting at?
Yeah, absolutely. So there's a few things to consider in the rental market. Firstly, the vacancy rates and the yields are an interesting one. Vacancy rates are around 0.4% right now in Albury-Wodonga, which is extremely tight.
It may as well be zero.
Yeah, absolutely. Yeah. And rental yields are just under 5.2%. So some suburbs in Albury-Wodonga, some parts of it average around that 5%. But across both cities combined, you're at about 4.8% yield. So it's still quite healthy in the gross. It's obviously not your regional Queensland or regional WA 6s and 7s, but remember it's a very diversified economy in town, and to have yields that healthy at that price and diversity is actually really, really well placed.
Talk to me a little bit about council rates. And I know this sounds probably like an odd question, but I've got a feeling you can already see where I'm going. Considering what you just said about, I know it's not like a far north Queensland, regional Queensland town. Council rates for Albury-Wodonga, are we talking a lot more normal, like the kind of like 1,500, 2,500, or are we still talking like Queensland kind of like $4,000, $5,000, $6,000?
Absolutely, good question. So they're actually quite normal. They're not really elevated. Same with water bills, insurance bills. They're quite similar to some of your major markets, right? Now, what you can do with that is you can look at that in two ways. Let's just say you go to Queensland and Queensland has much higher council rates, insurance and property management. And with those higher bills, that stings people, but they go, oh, well, the rental yield's higher. Well, if the rental yield in Albury-Wodonga is slightly lower, but the bills are also lower, they can actually be quite comparable. Now, let's not forget the land tax bills though in Victoria and the other bills.
Yeah.
But remember, if the ticket size of the price of the asset is smaller, so is the land tax bills too. So the key thing here to remember is that yields are healthy and these yields are growing because rent's continuing to rise and prices have not been booming in recent times. So it means it's affordable. Rental markets are tight because of vacancy rates being low and rental yields are improving. So something positive there.
I haven't done the calculation on this, but just roughly, if you're spending around $450, you're probably looking at what, like just over $1,000 a year in land tax in Victoria?
Yeah, so I just like to be conservative and assume sort of 2.5 in our calculations.
Oh, I'm way off. Okay.
Yeah, no, it's just better to be conservative, but then there's also rental compliance and gas and electrical.
Yes,
so 2.5 to 3K is a good buffer to make. But then in saying that, your council rates, water bill, insurances aren't anything like other parts of the country in regional centres. So from that perspective, things do manage to balance out.
I don't want to side quest this too much, but why don't we talk in net rental yield? Because like it's standard in commercial. It's what you do. We always talk in gross rental yields when we're talking resi. And like exactly what you just said, realistically is summed up in what does the net rental yield look like versus the gross rental yield? But we don't do it.
Yeah, it's a good point. I think that maybe we start something. Maybe we start talking it.
I think we should.
I reckon I should start getting calculations. I mean, we might be one of the first that start talking residential net yields.
Would make sense.
Now, I know we're going to piss off a lot of people though, because in doing that, it's not going to be pretty for many people, but at least we're telling the truth. We're telling where it's at. But I also think that because commercial success is so focused on the yield, That's why it becomes so prominent to isolate it and go deep into it, where residential's yields have never been the focus of its success. It's always been the growth of it, or the growth of residential property and the leverage you can get. So that's why people don't make it a core focus, because even if you brought the net yields and it wasn't a pretty picture and say 2% net after all the bills and stuff, people will still get into it just because the growth aspect is there for them. So I'd still be keen to bring it up to, front of mind for everyone and start doing that in future episodes. That'd be great.
That would be good.
I think we'd be able to do it, but it's not as clearly calculatable as well, because with net yields in commercial, they're all displayed on the lease. You're offered a net term and it's plus outgoings. Whereas in residential, you have to work your outgoings out on every property. You have to go rates, water, insurance. Whereas in commercial, it's just like, hey, here's your rent, and the tenant also pays outgoings.
It's a lot more clear cut.
Yeah, so it's just so much more measurable, so much more front of mind, because you just go, oh, it's that much rent I'm getting, so that's my net yield. So yeah, that's Albury-Wodonga in terms of some of its numbers there. But if I was to share a few other trends we're seeing in Albury-Wodonga, just out of interest. So when it comes to Albury-Wodonga, we've noticed a few things. So late 2024, sales volumes have started rebounding. So when more sales volumes occur, it's a sign of increased confidence and activity. Now, you never want to measure sales volume in isolation, which is why we look at inventory. But alongside that sales volume, listings have also been increasing. So it's kind of weighing it against each other. But nonetheless, the sales volume increase is healthy. But another thing we've also noticed is that days on market and vendor discounting has kind of started to flatten out. Now, that's a good sign. It means that it's not really getting much worse than what it is right now. It's kind of found a bottom and it's flattening out. So we call this market phase in Albury-Wodonga a second wind market. And right now it presents a very strong buying window, because if you're buying in that second wind just as it's flattening out, think of a hockey stick. That hockey stick was coming down because vendor discounting was worsening or days on market increasing. And now we're starting to see this hockey stick shape where it's rebounding, but it's not taking off and going crazy. It's just rebounding. So I think Albury-Wodonga has some really solid potential there, where people could buy in this little hockey stick phase where it's not undersupplied, it's not rapid selling, it's not low discounting, it's actually quite stable, but it's turning in all the trends. So I think this offers a little bit of exciting opportunity to many.
So the first thing that comes to mind, I'm just picturing someone like listening right now going, why would I just want that little bit? Like, what does the long-term growth look like then? Like, what would give you the confidence to go, yes, I'm talking about the potential for a short-term equity gain. However, if you're planting the seed here for the next kind of 10, 15 years, is that you basically pulling back on the whole, if we zoom out far enough, it performs at about 5 to 6% anyway?
Yeah, absolutely. It is a long-term performer. It's proven that over the 10, 15, 20, and even 25 years of data. You won't be buying in this city and feel like, okay, there goes my money, it's never coming back again. 15, 20, 25 years of data on all intervals showcases that it's a healthy market, right? What we're saying is that it went through a bit of a slowdown over the last 1 to 2 years.
Okay.
And in that slowdown, we're now starting to see the bottom of many trends, which start to shape a little bit of a hockey stick. And those hockey stick and some of the data trends we're noticing may offer you the opportunity to buy affordable with growing yields in a market where many people's eyes are on Melbourne, but there are affordability points elsewhere. And instead of buying a unit in Melbourne, you're able to, with a lower budget, operate in this city with a house. And it's got that long-term stability and confidence for you to start seeing that turnaround. So that's what we call a second wind.
So when you say you didn't use the words going down, but I can't remember exactly what you said. What was it again? It was correcting or something?
So it was flattening.
Flattening, that's it. No, with the flattening, as in it was literally going backwards, or the growth was just slowing?
Yeah, so growth rates were slowing. So give an example, 1 year average in Albury-Wodonga is about 2.5%, right? But the 3 year average is 6.5%. So it just shows you over 3 years, it was per annum, 6.5, 6.5, 6.5. But then if you'd made that just isolated to 1 year, it was only about 2.5.
So but it wasn't minus 5% or anything?
No, it wasn't going backwards by 5 or 10%, but it was just slowing down a fair bit. And now those trends are changing, where sales volumes are recovering, days on market starting to flatten, vendor discounting starting to flatten. So it's that hockey stick phenomenon I was talking about, where it's like falling, now coming around. And that little come around part, because remember, housing is not very liquid. It doesn't move rapidly in transactions. To see a trend change on what we call 12-month rolling data, it is a lot of transactions that form that change over many multiple months. And so it's multiple months of data shifting to allow for that recovery to even show in a chart.
Makes sense. All right. Finally, wrapping things up with Wodonga, economically, what makes you actually go, this is a place I'd like to plant my money long term?
I think the diversity of the town's always been there, from industrial to defense to medical to retail, even just being a little bit of a foodie town as well. I think there's a lot going on from the local economy in terms of its diversity.
Is it really a foodie town?
Yeah, but check out the cafes and restaurants there. They're pretty phenomenal, especially if you're driving from that Sydney to Melbourne sort of road.
Okay.
It's always a bit of a pit stop for us that we like and love it. So, but look, it's a diverse economy. There are some earmarked projects around hospital improvements and more defense contracts, but I don't like to rely on them as the reason. I think the main thing though is that there is always diversity in this economy. It's by no means a small town either, with 80, 90,000 combined in terms of all the two cities together and some surrounds.
And it's not like reliant on like one industry for like 50% of its like GDP.
Absolutely. Nothing like that. And it's also got the inland rail as well as a key stop there. So I feel like there's a lot going on from long-term potential and diversity. And the past of 15, 10, 20, 25, like 4 intervals of data has shown that. And it's just this little blip which is determining what we call a second wind. And it's essentially a period where there isn't as much activity and growth, but if you can get in, you're just buying well for the long term, and then it allows you that recovery when that time's right.
Got it. I just realized we're already like 15 minutes in and I just keep asking questions on the first area. So we should probably move on. But before we do, whereabouts are you ranking Wodonga on the list?
I'm ranking Albury-Wodonga as number 3 on the list out of the 5 locations we've got to cover today.
Done. All right, man. Let's move on. What's the next area we're talking about?
So the next area we're talking about is Shepparton. Now, I'll give you a few rapid fire stats on Shepparton. Okay. So Shepparton, similarly to Albury-Wodonga, is a long-term market with some stability, but not as stable as Albury-Wodonga in the long term, but still healthy. What many people don't recognize is Shepparton has a 5-year growth average of 10% per annum. So it's had an absolute boom in the last 5-year period.
Yeah, it has.
Absolutely. Now, over the last 2 years, though, it has slowed down a little bit, again, entering that second wind phase, but it's starting to recover again. But that last 1 year's data is telling at about 1.5% growth only over that time. Right? Now, Victoria as a whole has been hit. It's a common theme. Out of all 5 locations, I'm going to mention the same thing for almost all 5 of them, bar one. And all 5 of them, I'm going to say that they've had a second wind. And that just simply means that they went through a period of weakness after a boom, but those weakness periods aren't fundamental. This economy is really weak, or fundamentally everyone's unavailable to actually afford these homes, or everyone's lost their jobs. It's nothing fundamental in weakness. It's a combination of weak sentiment, tax changes, interest rate changes. There's just been this weakness or grey cloud over Victoria ever since the last few years of everything like that has come together. And I just feel like from that perspective, these aren't long-term fundamental weaknesses. These are things where I feel they could clear up over the years ahead. And so I think this is something across all of these 5 locations that's fairly common, except for one, which is carried through irrespective. Now, on Shepparton, some things to point out here.
I'm just curious what the one is, but you're going to hold me in suspense for that, aren't you?
I am going to hold that too. So stick and tune to the end. Stick and tune into the end. So I think the main things to point out with Shepparton here is that inventory has started to fall again. Okay. So from May 2024, inventory had peaked up to about 5 months of inventory. So it did weaken in this cycle, but now inventory is down to 4.4. So it is starting to have that recovery again.
So it's still above where you'd like to see it, but it's going in the right direction.
Absolutely. Now, that is one trend. Vacancy rates remain pretty low as well at 0.8%. And also rental yields healthy. It's been rising strong. So rental yields of 2 years ago were just about 4.6, 4.5, but rental yields today are at about 5%. So this rental yield, if it keeps rising like it did over the last year, because rents rise faster than prices do, you could see rental yields at about 5.3 to 5.5% a year from now. And suddenly that's going to get a lot of people attracted to it. When interest rates come down, locals will start being able to afford a lot more and look at it and be like, why am I renting at 5.5% at such a diverse town with affordable housing? And then secondly, B, is you're going to have interstate investors look at this yield and say, well, where across the country is starting to get this anymore? And places like Shepparton with a diverse economy, again, with commutability as well to Melbourne and its own sort of transport infrastructure that's been improving, medical infrastructure that's been improving, the lifestyle there, all these things are going to be well placed for it from a long-term view. But I just feel as this dark cloud over Victoria has to disappear. But if it doesn't disappear from policy changes, it does self-regulate and disappear over time. Because what happens is rents keep going up as prices don't and yield improves. Interest rates across a macro cycle starts to improve. And also when we see constant people departing the rental market, vacancy rates tighten. That also becomes an attraction point for future investors. And then the costs, because the costs stay relevant and the yields have increased, the costs of Victoria start to fade as a factor because the rents have continued to rise whilst the prices of the houses didn't. So everything's self-regulating, which means that if you're caught up in a period of like, damn it, I got into Shepparton over the last year or two and all this stuff in Victoria then happened, you can hold through, and some of the regulation that I'm saying in terms of self-regulation will occur, and you'll start to see Shepparton come out the other side, because it wasn't really its fundamentals that killed it. It was a lot of external influencing factors that impacted it.
Which is then shifting the sentiment.
Absolutely.
Got it. So you may have said it, the median house price?
Median house price in Shepparton is about $475K, based on our data, which is quite affordable. So to be under 500 for a city, that's pretty phenomenal.
Well, this is what I wanted to ask you as well, because you said, so what, the past 5 years, 10% like per annum? Like, so
That's right,
it's had
50%.
50%. So it's had some solid growth. So, and we're at like 475 now. My first question is like, if it's already been doing so well over the past few years, and you're saying it's like the hockey stick, it's in the second wind side of things, for anyone thinking, well, why is it going to keep going? Is part of this an affordability play? Because I know that you dive into the data of like local wages versus like affordability. What does that look like for Shepparton?
Yeah, so that's actually been improving over the last couple of years because income in the local economy has been strengthening, but prices haven't been growing over the last 1 to 2 years. Over the last 5 years, they grew strong.
Gotcha.
But over the last 1 to 2 years, they've slowed down. Now, I feel that that's going to start to regulate and improve. And one thing that's important to note is over the 20-year average, Shepparton's only at about 4.3% per annum. Whereas if you stretch Shepparton out to 25 and 30 years, it sits at about 5.5. So that means there's actually still more growth in the tank that could come about and bring it back to where the rest of the country is in terms of long-term growth rates. So I think that this next 1 year, if it continues to stay a little bit flat like it has been over the last, that might be some of the last years before it starts turning around again.
All right. So as far as Shepparton on the list, whereabouts is it ranked?
So on the 5 locations we've got, it's ranked number 4 on the list. Not too far behind Albury-Wodonga, but just a little bit behind it. And if we can start to see some of the trends improve to like how Albury-Wodonga has, then over the years ahead, we'll rank it higher.
Got it. All right, man. Moving on. What's the next one?
All right. So the next one is Ballarat. Now, this is not a small city. And so people might be surprised going, hey, can I get in the 4s in Ballarat? Well, short answer is yes, you can. Although you might have to get the hammer, the toolkit out a little bit so you can get a couple of renovations in there.
Yeah, I don't mind a bit of that.
Yeah, that's your specialty. But look, when it comes to Ballarat, I think this is the interesting one. I'm not saying here in this that Ballarat's ranked in the top 5, therefore it's the best, or it's one of the best, or even a great city from investing in the short term. Because the thing is, 5 or 6 is also most of regional Victorian towns. Like there's only about 6 or 7 major regional Victorian towns. If you add in, the Geelongs and the Warrnambool and a few others, you take it to about 6 to 8.
Yep.
So looking at Ballarat, whilst I share some data for it now, it's not to say that it's a phenomenal place to invest in, but it's more to say that it's ticking criteria of being able to get into it with its budget. It has some upside to it that I can let you know, but it also has some downsides you've got to be cautious of.
Yeah, I've got a feeling you're kind of very tactfully saying it's not at a very good place at the moment, but it could be heading in a better place.
Absolutely. So let's talk about it, right?
Okay.
Ballarat over the last 1 year, it's declined almost 6%.
Jesus, yeah,
So it's gone backwards. It's not a small drop.
Okay.
Over the last 2 to 3 years, Ballarat's averaged a negative growth rate of 2% per annum. So it's actually had a negative 3-year average.
Okay.
So that's not pretty. And the biggest reasons of that is if we take it back to 2021, the listings have almost doubled over that time period. They've gone from a rolling of 3,300 listings to just under 5,000 listings. So not quite double, but it's getting up there if the listings keep increasing the way they are.
So why Ballarat experiencing this more? Because I'm assuming already that this is probably going to be number 4 or 5 on the list. Like, and before I jump ahead to your score, because maybe I'm wrong, but why is this happening? Is it a socioeconomic issue? Is it a building issue, like an oversupply issue? It sounds like it's experiencing, like you described before, the big grey cloud over Victoria. It's copping a little bit more of that kind of darkness.
Absolutely. So I can't put it down to just one thing, but I would say from my external lens is that yes, building supply has been one issue there as well. But when it comes to overall, it is definitely facing the brunt a bit more. Like, to give you some context here, the days on market trends actually halved from 2017 to 2022. But then from 2023, the days on market doubled between 23 and now. So whatever it lost and whatever it improved, it
Went
just
straight
got
back to.
Right? And
what is that? How many days on market?
So it's actually gone from 13 days on market to 56. So it's more than double.
That's way more than double. That's huge. Okay.
It's way
56.
more than
Yeah,
doubled.
right.
So it was 56 and it went down to 13 from 2016 to 2023. And then now it's gone from 13 up to 56.
Wow.
So it's back up again to where it was.
56.
Right?
Okay.
Now, what's interesting though, and this is the part where there is some good news to be had, and there's some good news is inventory, although high, because of the listings increase, is declining.
Okay.
So it's not declining because of listings coming down. I already shared that listings are increasing, but it appears sales volumes are recovering quite heavily. So even though more stock is becoming available, it appears a lot of buyers are coming out to come and capitalize on that more stock. Because remember, if there were 3,300 listings this time, sort of 2021, 4 years back, and that trend had come down from about 4.4K listings down to 3.3. It went from normal supply to undersupplied.
Okay. Yep.
Now it's gone to oversupply at just under 5.5K listings, right? And so whilst that listing's gone up, that listing's more higher than any year going back to 2015. So that means there's been a lot of people in Ballarat who have a lot of choice.
I'm just trying to think now. So what's Ballarat's population? Like 100 and something thousand?
Yeah, it's
And 5,000 homes being sold. If you got an average dwellings of like, what is it, 2.8 per, I'm doing real quick math. There's like 30,000, 40,000 dwellings there. And 5,000 of them were for sale in the space of a year. That's a lot of people wanting to get out.
Yeah, and the transactions have been half that. So it's been a lot of stock sitting in the market. So the 12-month rolling transactions per annum are only about 2,500. So people are having a lot available, but only half of that's being snapped up. So it's almost like half the market's forever sitting on the market whilst half is only being snapped up. So that's not a pretty picture, but the sales volumes are increasing. So that sales volume average was about 1.8K in 2024.
Yeah.
And now that's about 2.5K. So you can see that's a big increase. That's almost a 33% increase on sales volumes just over the last 1 year. So yes, bad times for listings and price weakness, the declines there, but it appears that there's a lot of people swimming around trying to get a bite of the deals, and they're getting in there because they believe Ballarat's a long-term performer, which technically they are right.
I was about to ask you, why the hell is this even on the list? But so this is why, because it's
This is why. It is a long-term stable market in terms of, not stable because of last year, but it's a long-term market that has averaged at 5% to 6% ranges as well. In particular, the last 15 years have been around 4.5%, and it's been dragged down because of the last 3-year average. But if you looked at the last 25 years of data and excluded the last 3 years, you get an average of just under 6%.
Did you ever read Steve McKnight's book, the 0 to 270 Properties?
I didn't, no.
I think his very first purchase was in Ballarat, and he bought a place for 20 grand and it doubled to 40. And then he bought a few more for 40 and they doubled to 80. And I see what you mean. So like longer term, it's been kicked in the guts in the short term right now, and the data is really not looking good. But you're looking at this from more of a, there is potential to maybe get more of a deal, more of a bargain. But you do not want to be doing this over the year or two. You want to be having a 10, 20-year lens, really.
Absolutely. If you're trying to get into this market right now, you're getting into declining inventory, which is a great start of a new cycle.
Yep.
But it's just not high enough in pressure to be considered anything near high growth. So what you're doing right now is you're just getting in, if you are buying it, to hold a position at a good buying window because it's easier to buy, it's available to buy, you'll snag a good deal, and you might buy properties that may never come onto the market again. Because remember, in 2016, you're averaging just around that 4K of listings. You're now 1,500 up. So if you're averaging 1,500 up, you're buying properties that were never there before or never hitting the market before. So there's a lot of clear choice. So if there's that home buyer here, probably a pretty good time to secure something. But if you're an investor and you're buying here, you're not buying here for any short-term meaningful growth. You're buying here because you feel like you're liking this position of being in this market for the long term, and you think this might be the only time to get something quite affordable for a long-term market that's been quite consistent in the past. Now, rental yields, they're not as good as the other two markets I shared with you. Shepparton's got better yields, Albury-Wodonga's got better yields, but the yields are improving because the prices are declining, right? So rental yields before were around 3.6%, and now they're at 4.2%.
It is lower, you're right.
So low for a regional city in comparison to others, but you can almost treat it as an extended capital. You can get in and out of Melbourne within an hour and 25. It's not by any means a long way away. Now, that's obviously off-peak, but the main thing to say here is that Ballarat is a beautiful city. It's got a lot going on, the lake, the proximity to Melbourne. Like, it's a nice spot. It's just going through a weak patch, and if you're looking at this, you're only probably looking at this from a, wow, a city like this is not going to be this cheap for a long time. I want to hold something here. And if it doesn't do its thing over the next year or two, I'm okay. Lots of choice available. I will negotiate well. Maybe you get something with reno potential, maybe something subdividable, because you can see something there that might be easy to pick up and negotiate on. But sales volumes seem to be jumping up 30% plus. So if this continues for another year like that, then suddenly that recovery window's gone, and another year or two of sales volume jumps like this, and you're back into a boom again. So
population-wise, like you're saying, Shepparton is more around the 5%, 4.2% here for Ballarat for a gross rental yield. Shepparton, what is the population? Is that's much smaller though, isn't it? Like 30, 40?
Smaller than Ballarat, but not super small.
Okay, all right. I'm just wondering if there's any kind of correlation to that with the population size, or is that just a bit of a...
No, look, population growth's been increasing. So you've got to look at population a little bit differently. You'd think that with population growth increasing, it means it's booming times. But remember how I talked about one of Ballarat's reasons for the slowdown being new supply? That new supply in Ballarat is a reason for the slowdown. And how you can comfortably say that is population growth's been booming. Because remember, population growth can't rapidly grow unless there's housing available for them to grow it. And so either new people are coming in living in the same houses, which I don't know how many people have all cousins living in Ballarat so they can crash with them, or uncles and aunties and mums and dads all in Ballarat so they can crash with them.
Maybe, but probably not.
Probably not. I think if people are moving to Ballarat, they might need new housing, right? And so if they need new housing, it's clear that if population's growing, there's an abundance of new housing to make it possible to grow. And that's the case. We can see some strong population growth rates, not just in recent times, but it's been booming since about 2015. However, it appears it's booming at a faster rate than ever since 2021 to 2025, which means that if it's booming faster than ever, it can only boom in population if houses are there to meet that population. So it's clear that population growth, whilst great long-term, may offer more prosperity, jobs, spending, economy, they can go through bursts when population does increase, and it doesn't positively help the market because it's a supply response.
That makes perfect sense. Okay. Is there anything else that you want to talk about with Ballarat before we rank it on the list and move on to the next?
No, it is ranked, unfortunately, number 5 here. Great for long term, but in the short term, it's not pretty. But the sales volumes that happened over the last 12 months, 30% jump, happen again. You're talking some serious recovery about to kick off in Ballarat any minute if that does happen for 1 or 2 years in a row.
All right, so quick recap. So number 3 on the list is Wodonga, or Albury-Wodonga. We're kind of putting them both together. Number 4 on the list is Shepparton. Number 5 on the list is Ballarat. Now we've got number 2 and number 1. Are you spoiling? Are we jumping straight to number 1, or are we going number 2? Because people are going to know before we rank it now.
Let's go number 2.
Number 2. Okay, what is number 2 on the list?
Number 2 is market of Greater Bendigo.
Bendigo. Okay, why Bendigo?
Well, Bendigo is ranked number 2 because the recovery is just showing a lot more than some of the other markets, okay? So the first thing I want to point out here, and I'll use this data point in both Bendigo and the number 1 position market, which we'll unveil in a second. But with number 2 in Bendigo, there's something we track called 90-day rolling data and 360-day or 12-month rolling data. And the difference is this, and the best way I can explain it for my fellow data nerds is that when you have a 12-month rolling data set, it creates an average or a number today based on the last 12 months of data put together. Okay. But if you grab a 90-day average, you're creating a data set today by the last 3 months.
Yeah.
So to put that into an example, if you had 50 days on market as a consistent trend for 11 months, but on the 12th month you had 20 days on market, someone who sees the data at a shorter interval stage will notice that sudden change more. But if you notice that on a 12-month rolling data, you've got 12 months of data of which 11 months say 50 days and the 12th month says 20 days. That 1 month isn't enough to move the average of the other 11 immediately. And this is when you get data lag. You now have to wait for multiple months of that data of 20 days on market to hang around there or below for the whole 12-month average to start changing, right? And so you're going to keep waiting, and then you're going to notice something maybe 6 months later. Whereas someone who had the on-the-ground knowledge or localized contact knowledge or national view with contacts everywhere knowledge or data at different rolling levels knowledge, they will figure out something is happening in that city ASAP. And so this is something we love to overlay. So I'm almost like imagining this. Imagine one dark line and say it's going up in days on market and it's a dark line. And in this dark line, we overlay with a dotted line but it's going up with it and then suddenly starts going down before the dark line goes down.
Mm-hmm.
And what we call this in the data world is like a pattern break.
Okay.
It's essentially something that was maybe going from 20 to 40 to 50 days on market, worsening on the 12-month average.
Mm-hmm.
But then we see this dotted line at 3-month rolling of same thing, 20, 40, 50. But then instead of going up with the blue line all the way, it started coming down. And the reason why is that 3-month rolling captured the last 3 months of the data actually faster selling from 50 to 40 to 30 to 20 days on market.
Yeah.
Whereas that 12-month rolling still has 9 months worth of old data sitting into it that isn't enough to move the curve yet. So you're catching a curve movement on a shorter term data set before the longer term data set shows it. So you're trying to eliminate as much of the lag as possible.
Are we basically talking about that? Because you lose me a little bit here with lag, because I'm feeling that you're talking more about getting rid of the average that kind of skews it. Because if you're dividing it by the 12.
Absolutely.
Right. Okay. So you're almost looking at it through the lens of more of a median than an average?
So you're still looking at the average, but a shorter time period.
Right.
So instead of looking at 12 months data, you're looking at 3 months because it's 90-day rolling.
Got it.
Now, when you look at that 3 months, there is some cons to it. 3 months is not a long period to assess any data, is it? So it will zigzag a lot more.
So, and this is why it's used in comparison, not in isolation.
Absolutely. You can't use it in isolation because with 3 months rolling, when that curve was going up on the 12-month rolling, the 12-month rolling data set was quite smooth. It was a smoother line because there's a whole bunch of averages sitting in there. Where the 3 month was still trending up because the 12-month together were trending up, but it was like a roller coaster.
Yeah.
And it's just because it's using shorter average periods. So in a 12-month average, you could have 20 days, 22, 37, back to 22 or something like that. And it's just one little odd number, so it won't shake the whole line up. Whereas in the 3-month average, if you have one odd month, say Christmas closure period, that 3-month average is going to be funky because that 1 month is 33% of that data set.
Got it. Yeah.
So
okay.
why that's important for me to break down into good depth there is that we're seeing the 90-day rolling data in Bendigo and the number one location start to show some pretty rapid improvements. So that means that something's about to change in these cycles in the longer term data sets, but it's just not showing it just yet.
So talk to me about the 12-month data first before we get into the 90-day. What does the 12-month currently show that you're now seeing different in the 90-day?
Absolutely. So let's talk sales volumes in Bendigo. So the 12-month rolling shows sales volumes have been pretty flat over the last year. But over the last year, we're seeing a tripling in some suburbs sales volume numbers. So it's showing that there's a big recovery in people buying and transacting in Bendigo.
Got it. Okay, yep.
We can also see inventory levels start to come down in the 90-day rolling too. So just starting to see, because of that sales volume jump, even though listings have elevated a little bit in the last year or two, we're seeing the sales volumes jump up pretty quickly. So if this continues, although it's a short-term trend, if this continues, Bendigo could get back to some recovery. And speaking of recovery, it's another long-term consistent market with just under 6% growth over the last 15 years. So Bendigo is a great long-term stable, diverse market, but it went through, like that cloud I was talking about, all over Victoria. Over the last 3 years, it went through a little bit of a slowdown.
Because you got one in Bendigo a while back, didn't you?
I do. So I bought it in 2020, I think around 380,000.
Yep.
And I was quite lucky with it in terms of everything that happened. It boomed quite well. It's valued in the high 5s, low 6s, depending on which value you ask. So that's gone up pretty well in a couple of years. But then in that last 2 years, it really hasn't moved. It's come back pretty quickly. I think at my peak valuation, I had it at low 6s, but then I reckon it's probably worth high 5s now to be conservative.
Now, I know you're not against selling. You would actually look at restructuring a portfolio. Why not sell? Like when everything started going down, what made you go, nah, I'm in it for the long term here?
This is a message for pretty much everyone who owns property in Bendigo. I believe in something called the second wind of markets. And I only believe in it if I can see the trends shaping there or if the fundamentals of a city haven't been drastically weakened, right? Now, in the Bendigo case, when it went through the slowdown in recent times, I talk about that dark haze over Victoria from sentiment, policy shifts, interest rate shifts. It's like a triple whammy all in one. That part there, it to me, is not a long-term structural foundational shift.
Okay.
It's still a picturesque town with a great diverse economy. Over the last few years, invested in a $680 million hospital.
That's quite pretty.
Absolutely. It's quite pretty. It's very diverse when I mentioned that as well. And it's pretty commutable. And overall, the supply levels, although they had a little bit of an increase in short-term trends, they're actually still down a bit in comparison to some many years ago. To give you some context, back in 2019, the peak levels of supply here in Bendigo in terms of the 12-month rolling listings were just around 4,000 listings. Bendigo now is at 3,100. So over that 2019 till now, there's still an undersupply in place. So it's not so much this is oversupplied, super weak, like the Ballarat example where listings just spiked up. We look at data over 10 years and a 2 year. So if you look at a 2-year trend, Bendigo's listing data isn't pretty. You essentially jump up a little bit on the 2-year trend. But on the 10-year data trend, when you isolate years like 2019, you look at now, listing volumes have actually come down. So it's actually not this massively oversupplied market. It's just that sales volumes also went down over that time and people's demand fell off. If I see a really weak economy combined with a huge overlay of supply, both in new and existing supply, a weakening rental market and just low confidence of the state and everything like that all together, then that's clearly a sign where I'm like, damn it, wrong choice, wrong market, I should get out, right? But I'm looking at this data differently. I'm seeing unemployment rates that were close to 7% in 2015, now at under 4% in 2025. I'm seeing diverse range of infrastructure. I'm seeing a diverse economy. I'm seeing commutability. I'm seeing lifestyle. I'm seeing listing levels far lower than what they were in 2019. All we've just had is this weak sentiment, extra taxes, a complete fall off in sales volumes. So to give you some context here, sales volumes in 2023 were 2,400 and last year it reached a lowest of 1,400. So it almost halved. So it's almost like a demand falling off rather than fundamentally a market becoming weak. And it times really well with law changes, interest rates increasing, more weak sentiment, all that sort of stuff. So if we can start to see things roll back, and it can roll back through self-regulation, which is more investors exit. The rental yield keeps rising, which is another thing. In Bendigo, the rental yield about a year and a half ago was 3.8. It's now 4.4.
Yeah, wow.
Right?
What's the median house price?
Median house price in Bendigo in our data is around $550,000. So a little bit more than some of the other regional centres in Vic, but still very affordable for a large regional centre. And again, commutable to Melbourne with its own major economy. You don't need to go to Bendigo to live and then work in Melbourne. You could live, work, play in Bendigo. It's its own city. So I know the median house price I mentioned earlier is $550, but there is actually a lot of places in Bendigo where you can get it for cheaper, and that too with some good renovation potential as well.
Okay. I've got to ask, I don't know if intrinsic value is the right wording for this, but just bear with me. So I keep thinking about Ballarat. Bendigo, if you're looking at all of the regional towns around Victoria, right, and locals would know this. I've spent a bit of time in Melbourne recently. I was going out to Melton a bit. Personally, I like Melton. I was like, this is nice. I talked to locals and they're like, Melton. And they had real negative things to say about it. And I was like, I couldn't see it. I thought it was lovely. Is there like a local kind of, and I don't want to use the word stigma, but like does Ballarat have almost like a lower intrinsic value to it than Bendigo does? Like locals are kind of like, oh yeah, I'm happy to live in Bendigo, but Ballarat, I don't know about that. And we don't see that in the data?
Yeah, it's a good question. So yes, you're right from the words and the discussions and the stigma, but you're wrong from the impact if you think it has any on the long-term performance. Because Melton's actually still done quite well. So what's interesting about Melton is, yes, there's a lot of people and probably more that say that in a certain way about it. But I funnily enough, like some of my wealthiest clients, one of them has a multi-8-figure business. Lives in Melton.
Yeah, right.
Right. It's crazy, right?
Yeah.
But I mean, people have different reasons to live in areas. It's not affordability, especially if they're doing multi-8 figures in revenue. For them, it's community. For them, it's locality. For them, it's, relationships they have there. For them, it's a bit of space, a bit of nothing around them, right? Maybe a modern home is interested to them and not modern homes and in other locations. So I think that each to their own is always my thing. And there just might be a lot of who you talk to says it. And if you're in Melbourne, it's not like you're flying out to Melton to sit there and talk to people about their opinions. You're usually flying to Melbourne, you're in the CBD, you're having a bunch of mates who probably live in and around there. And they're going to comment about an area that's much further than when they are. And so I would say let the stigmas be that. The data over 20 years shows some great things. But if you want the stigma to be in your favor and the data to be in your favor, then if you've got places like Bendigo where you've got the artsy, the food, the culture, the commutability is much the same. You've also got the lifestyle. You've also got the homes that are prettier. And if you want the newer homes, you've got that too. And for much the same dollars and cents. I think that's a double win. But if you're talking data alone, they both have that strength there in the long term, and they have been. But really, in terms of Bendigo, that answers your question, I guess, around why I haven't sold it. It's because unemployment's strong, diverse in economy, lifestyle strong. Victoria for my portfolio allows me to be diverse. It's done well. It's just the demand fell off over the last 2 years, but fundamentally it's very strong. So all it'll take is a little bit of kickback in demand, which is already starting to happen in sales volume, and Bendigo will be a strong performer once again. So I'm expecting the next 12 months for pretty much all those markets I've said to be in this recovery-ish type mode, except for Ballarat. I think the recovery is going to be longer. And Shepparton, I'd say, is just starting. But Wodonga and Bendigo, ranked number 3 and ranked number 2, the recovery's already started.
Is there anything else you wanted to add to Bendigo before we jump into number 1?
All I'd just say is similar to, Albury-Wodonga as an example, is that the recovery starting, that hockey shape's there, it's taking place. So if you're seeing it as a market where like you're looking at it and going, I don't have something in Victoria, my budget's affordable, I want to have a town that has all the upside of the non-data things and the data things, Bendigo's staring right at you as a moment where you can buy without as much competition. And be patient, because that's what second winds need. They need that 12, 18, 24 months of patience.
But not as patient as Ballarat.
Not as patient as Ballarat. Right? I think that needs a bit more, unless the sales volumes keep going another 30%, another 30%, another 30%, then it's going to be crazy again. But you can still have some time because the listings have spiked a lot. Whereas in Bendigo, the listings have not spiked crazily, but the demand is now recovering again.
Got it. I want to insert a drum roll, bringing us to number 1 on the list. Which Victorian regional town are we looking at?
We're looking at Mildura. Mildura is going through another resurgence, another mini boom is happening there right now. The last 12 months of Mildura have shown 9% of capital growth. That is not small.
Yeah, right.
9% of capital growth is massive. That's above the 15-year average of just under 6%. But even that alone is phenomenal. 6% for a 15-year average. That's what you want, right? Long-term strength. But Mildura has kept keeping on, right? The last 3 years, it did go through a mini second wind. So we call second winds phase 1 and phase 2. Okay. Phase 1 is that decline part, but we think it's fundamentally still strong. So it just needs that recovery boost.
Just hold on.
Exactly. Yep. Or get in for that decline.
Yep.
Then phase 2 is the recovery. It's the actual second wind, like it's phase 2 as in it's now picking up. Mildura is going through that right now. It's going through another mini boom as we speak, and prices are up near 9%. We're expecting a strong growth year again for 2025, potentially even 2026 as well, because this level of recovery, I talked about those 90-day intervals, it's picking up strong, right? Now, the key things to shout out here, let's have a look at it. Days on market has fallen off heavily. If we go back to 2013, days on market was around 78 days. And I want to point out 2013, that little bit longer, just to show you the depth of how far it's come down. Okay. It's at 21 days right now.
Yeah,
right?
wow. So it's like a quarter of it almost.
Absolutely. Now, it's not the strongest rates of growth that Mildura's had, while still very strong. 2021 was a much bigger boom. But in 2021, 22, to give you some context, Mildura's days on market was 15 days. So 15 days was the bottom it got to, very strong. It's now at 21 days, still very strong. So it is better than where it was in 2013 by a long mile. So we're going through a clear boom. Another thing that we can see here in Mildura is that listings fall off. So to give you some examples, in 2023, it did go through that little weakness as I was sharing. And in 2023, listings got to about 1.5K. Now, the 12-month rolling listings currently is 1.15K. So we're seeing a big drop-off in listings there, almost 20 to 30% in listings drop-off has occurred.
What's inventory?
Inventory now is declining massively. It's actually really tight. So inventory before was 3.3 months of stock. Yeah. We've now got inventory at 2.25, which is essentially boom territory. And anytime you're in inventory of sort of 2 to 3 or below, it's guns blazing. So I would say, by the way Mildura is going, you probably could get a between sort of 8 up to 15% growth over the next 12 months if it continues these sorts of trends.
You're already
especially with that.
Are you already finding it harder to buy there? Like, is it picking up enough that it's like it's getting tough?
It's tough. Okay. Right now, it's fast moving, it's tough, and the activity is clear. I think people are catching on, right? Because the thing here is that sales volumes are picking up, listing levels continue to come down, vacancy rates are at 0.6%, and rental yield had an increase because that little second wind phase 1, essentially rental yields were at 2023 in February, 4.8%, and then they went up in 2024 to about 5.2, and now they're coming down again to 4.9. Which means that the pressure is building in price growth because the yields are falling back again.
Can you say those numbers again? So that was quite the roller coaster.
4.8,
yeah,
5.2, and then back to 4.9.
Right. Okay.
So little numbers on the screen, but it's there.
So sitting at 4.9 now, and this is obviously the average or the median rental yield.
Yeah, the median. And then in terms of purchase prices, you're right at that 450K median. So looking at the 4s and 5s are very common in Mildura, and without much reno, surprisingly, you could get something in the 4s and you'd be okay.
I've got to ask, why is this number one? Because you just talked so favorably about Bendigo, and realistically, you talked pretty favorably about Shepparton. That was number 4. Totally understand why Ballarat's not number 1. But why is Mildura sitting at the top of the list for you?
Yeah, it's sitting in there because if you had that 450K and you're trying to get the fastest level of growth in a state that hasn't been seeing much growth, well, that's your ticket right there. Because if you're looking at 8% of growth over the last 12 months and you compare it to Melbourne, Melbourne's gone back 2% in the last 12 months. Mildura's up almost 9. It's about 8.5. So that's massive. So when you're talking about the momentum, you're ranking it from Mildura first. Bendigo's recovery is starting to take shape. Albury-Wodonga is a close tie with Bendigo, just a little bit under. And then you've got Shepparton coming around, but still early. And Ballarat, quite a little bit to recover, but sales volume, if they replicate what they did last year over the next 1 or 2 years, then Ballarat's supply will start getting swallowed up. But Ballarat's still quite heavily oversupplied.
Out of interest, if I was to reshape the question and ask you which one's going to do the best more longer term, and I know 10 years, 15 years, there's no crystal ball to this. Data starts to get very blurry when you look out that far. Would you still have it in this order?
If I go longer term, Albury-Wodonga just seems to be the most consistent out of all 5 of them. And it just seems to have so much long-term growth there. But if I was to go short term, you can't get past momentum. And momentum's clearly sitting in Mildura. It's starting in Albury-Wodonga and Bendigo. TBC for Shepparton to come around. And Ballarat's still got a fair bit to go.
Yeah, a lot. Yeah.
Yeah. The listings need to get swallowed.
Yeah.
But the sales volumes are up 30%. So if that keeps on going, then the listings will be swallowed.
They need to be swallowed. I don't think I've heard you use that term.
Yeah, I don't think that's a great word.
Let's leave the visuals
absorbed?
alone.
Is that a bit of
let's go with that. Absorbed. Yeah.
Get your head out the gutter, man.
All right, man. So as far as Mildura is concerned, economically, can you tell us a little bit more as we're starting to get to the pointy end of things? Why is Mildura so stable economically long-term as well? Because this is a smaller town again, and we're not talking Ballarat, Bendigo kind of distance from a major CBD. This is, 4 or 5 hours away? It's on its own.
It's on its own a fair bit. Now, it's not as stable economically as other regional towns I've mentioned. All the other regional towns have a more stable unemployment rate, local economy, but it is still diverse. It's just not full of strong industries in multiple directions. It's got the agricultural, it's got the retail and hospitality, tourism-wise is still there, but it is stronger now in its economy. So to give you some context, just talking in isolated unemployment as an example, in about 2016-17, unemployment's around 8%. Now they're about 4%, right? So that is a healthy improvement. Not the lowest it's been, about 3.5 was the lowest it's been in 2021. It's still strong, right? Yeah. Absolutely. So the economy's in a lot better shape now than it was in the past, but it's not as diverse or strong as some of the others I've mentioned.
Got it. All right. So recapping the list from 5 down to number 1, we're looking at Ballarat is number 5. Shepparton is number 4. Wodonga / Albury-Wodonga number 3. Bendigo's at 2, and Mildura is at number 1. And with a median house price of $450,000, suggesting that if you're rolling up your sleeves, you could potentially even get something in the high 3s, low 4s. Otherwise, if you're looking more set and forget, you're looking 4s and 5s. So we're talking some very affordable price points here. But what I wanted to ask you is, what's your action step for this? If someone's listening to this going, all right, I like the direction this is going, pull out the headphones they can put into practice straight away.
Yeah, absolutely. So I think instead of an action step, I do it as a reflection exercise. And the reflection exercise is to go, what are you chasing, right? If you're chasing a very long-term market, you want to get a deal and you want to have some power in the negotiation, then Shepparton and Ballarat are your 2 plays, right? If you're looking to time a recovery just before it starts to come around, Albury-Wodonga and Bendigo are sitting there. And if you're looking to capture strong growth momentum and continue to ride that wave, Mildura is your friend. So this is the way I'd say you reflect on your portfolio as you exercise, look at where your budget is, look at what your portfolio holdings show, and then look at, out of these 3 types of plays, distinct strategies, what suits what you're trying to get most. And that will help. Other than Mildura, you're not going to get a spike immediately in any of the other areas, but they each have their pros based on what I've just discovered then.
Got it. I think that's such a good one, because being able to actually reflect on where am I in my journey and what do I really want? Because there might be some people listening going, of course I want the short-term growth, but it's not everyone's at that place. And sometimes you actually are better off, especially if you're at the point where you're going to take a knee for a little bit, to actually get someone that's going to do better over that longer term because you're not going to do a refi in the next kind of 6 to 12 months. You're not going to try and pull equity out. You just want that stability to it. I like that, man.
Really good point. And, I want to mention one more thing. That's kind of like the many people that have made moves in Melbourne the last 12 to 18 months. They've bought there going, look, I don't see it doing anything immediately. But to be in a place at that price point in a city like that, for that entry point and entry moment, I can afford to wait. I might be in my 30s or 40s and you have another 2 decades in front of you as an example, or 3 decades. So you might go, hey, well, I don't want to be that person in the frenzy between 2012 and 2017 going crazy when Melbourne was going wild and trying to catch your tail. I'm in there now. When it comes, it comes.
Selfishly, I actually don't want it to. I want to keep buying that. This is something that we get accused of a lot. It's like, oh, you're just pumping the tires of an area that you want to big up. Like I actually was like, I don't know if I want to talk about the area because I don't want to big it up. I want to keep buying there and because I do believe in it so much, but it's longer term, like you said, I'm not expecting much to really happen in that little short-term window.
That's right. That's right. And that's why, like, I talk about this chart I shared in another episode we made on our show. So on the Investor Kid podcast, we made this episode, and that particular episode was to show like the 3 different dots of all the SA3s across the country. That
was good. Yes.
And we showed in this video, okay, over the 5-year period of 2020 to 2025, what's all the growth that's happened? With some average like 16% per annum and some average 2% per annum over 5 years. Monstrous separation, dots everywhere. Then over 10 years of 2015 to 2025, it was still spread, but it was spread between 8 to 10 on the top end and -2, starting to get closer. And then the third and final charts is like the 20-year data, and it shows almost everything hitting between 4 and 7%. So what happens is you get spread, tighter, and very tight, meaning every location has its time in the sun because of the spread, but then also long-term, majority of Australia averages growth rates that are similar. And so that Melbourne example is short-term it might not do some things, but you're positioning yourself for a long-term play in an ideal short-term position, easier to buy, cheaper to buy, and yields are recovering. So every year your cash flow gets better, interest rates come down, rents go up. Even with the taxes, they're getting fought against with higher rents rising. And so as a result, this is where you're able to hold for the long term, but not stress so much about the short term. And that Melbourne example, or Victoria as a whole here, is a perfect example of that.
It did feel weird going to opens and like having one other person there.
Yeah.
it's being so used to everything being so crazy.
It's literally a 1v1, like a proper fair fight.
Yeah.
Let's get it happening.
Oh, mate, I know it's time for you and I to actually go out and grab some dinner now, but I want to ask you the most important question with a slight twist, because I know you bought a lovely new home recently. Arjun Paliwal, what is now your favorite pizza to make at home?
Oh, this feels like that. He's got a millionaire hot seat now, and I'm trying to. Okay, I'm going to be bad here. I don't even know if the Italians will approve this because it might not be a pizza.
We can ask Jeremy if you want.
Is a Nutella pizza a real pizza?
I guess it has the word pizza in it, so sure.
Yeah, I've been loving just a real small dessert pizza, smashing Nutella on it like no tomorrow, and just having that.
Okay, Nutella pizza. And you're actually making these at home?
Oh, no, not at all. I can't make pizza. Come on, man.
That's my question.
Butter chicken? Yeah, we can do that, but not a Nutella pizza.
Have you done butter chicken pizza?
Yes. So shout out to Monty's Pizza in Sydney.
Okay.
They've got a franchise where they do butter chicken pizza, tandoori chicken pizza.
Actually, this is sounding familiar. I think we might have talked about this before now.
Yeah, I think so. Chili paneer pizza.
Yeah.
Oh, okay, I could go on, but that's one. But yeah, I'd just say I'd keep it sweet, chill. Nutella pizza seems to hit the spot. But if I was to go non-sweet, go savory, and I'm extending this pizza commentary.
Yeah.
I'm going to say this time around, I'm sticking with just a hot honey pepperoni pizza. This hot honey thing's become the new thing.
It is good.
Like Bell's Chicken, best hot honey sandwich ever. McDonald's just started going down the hot honey burgers. Now they're releasing that. And so pizza, hot honey drizzle on top, game changer. Pepperoni.
Yeah, we went out to some food and wine festival on the weekend. We never get out to these things anymore, but mate James invited us, and the hot honey was there, and we got we stocked up. It's good stuff. I'm with you on that one.
But you know the problem now is my calorie counting means I have to have like a perfect slice. I pull out this pocket weighing machine of late, chuck the calorie pizza on there.
What do you mean pocket weighing machine?
So I've got a scale now that I've started to take around with me.
You're going to look like a drug dealer walking around.
So you weigh a piece of pizza, you chuck that into ChatGPT and AI it like what you're eating.
Yeah.
And then I always ask like restaurants can I have a tablespoon, a teaspoon whenever they give me sauces. So I put the honey on the tablespoon.
Wow, you're full on committed to this.
Yeah, and then I chuck it on top. Man, I'm down 10 kilos in between January and now in April. So yeah.
All right. I'm going to jump on Amazon and grab a pocket scale.
Pocket scale, and always have a tablespoon or teaspoon, and then chat GPT your food log for the day.
I love it.
Way to go.
Arjun, it is always good fun chatting with you, mate. This list I know is going to help a lot of people and bring a lot of clarity to different options and what people are thinking as far as investing in regional Victoria, but investing on a budget. We're not talking about the clientele that are on 200,000, 300,000, 400,000 a year. We're talking about young people in their 20s. We're talking about families that are maybe single income families, people that are trying to really make a go of it and plant the seed somewhere that has really got some longer term potential in Victoria, mate. But is there any final words of wisdom or anything you'd like to leave us with today?
Nothing really beyond the fact that it's a rare time where you're going to have an opportunity to buy in price points like this. And it's not going to exist for long. I know that sounds sad, but the things are incomes are rising. So it's not all negative. Interest rates are likely to come down. And to have a weak level of sentiment in a state with this level of affordability and that level of size of economy and depth of economy and diversity, the foundation's there. This recovery will allow it to occur, but you want to be on this side of the recovery, not the other side when it's firing away in all cylinders.
Arjun Paliwal from InvestorKit, thank you so much, mate. It's always a pleasure having you on the show.
Great to be on, my friend. Thanks again.